Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. On today's episode, we dive into the risk of tariff policy proposed by President-elect Trump and reaction to news on the U.S. Department of Justice working to have Google divest its Chrome web browser on anti-monopoly grounds. Joining us now is Rob Haworth. He is Senior Investment Strategist at U.S. Bank Asset Management Group. Rob joins us from Seattle. I'd like to begin, Rob, with a story that just broke after the bell here in the U.S. on Monday. Top antitrust officials at the DOJ have decided to ask a federal judge to force Google to sell off the Chrome browser. Now, that seems to be a pretty aggressive crackdown. Now we know that the administrations are in the process of transitioning here. It's not clear to me that the next DOJ would decide to pursue such a drastic measure. How do you understand, generally speaking, regulatory risk that the incoming administration represents?
Yeah, I think our interpretation, and we're seeing the market think this too, right, that regulations should generally ease across many, many sectors, and that could include technology. But I think the hard part we're seeing right now, because we also saw news that they may be a little more concerned about autonomous vehicles, right? So I think it's going to be fairly granular how the new administration approaches this. They may or may not support this. We may see a lot of this walked back. And that's kind of the challenge as we look through the cabinet picks today is it's not clear yet to us what the exact policy path will be. How far will the administration go vis-a-vis the election promises that were made? And what will the outcome be? So I think this is something to watch in the near term. May not be a long-term problem, but could be.
One of the things that we're waiting for is the nomination for U.S. Treasury Secretary. According to Bloomberg reporting, there's concern that it may be difficult to find someone completely aligned with Mr. Trump's economic agenda. And that goes to the heart of the matter, since he campaigned on applying tariffs on imported goods, especially those from China. To what extent is the risk of these tariffs a major risk for the American economy and, by extension, the equity market?
Well, yeah, I think we absolutely have to pay attention to tariffs and how they shift the landscape, and particularly the price landscape. Over the first administration, the increase in tariffs did not lead to inflationary pressures, but we also know it was a more modest increase in tariffs than what we're hearing proposed today. I think we're going to have to, again, right, to your point, it's challenging to find a Treasury Secretary. I think it's a question of who will be in the administration and how far will these go in changing the inflation outlook here in the economy. I think we're a long ways away from being worried yet, but it is something I think we have to pay attention to. And certainly as we think about our longer term scenarios over the full business cycle, thinking about the next 4 years, it's a risk we want to manage towards.
What did you make of the price action right after the election? We were talking a lot about the Trump trade being on in full force. It seems to have dissipated a little bit since that time. Can you give me your sense of how you're reading the tea leaves right now?
Yeah, absolutely. I think right after the election, the thing that really wasn't baked in was the Republican sweep. That was, I think, the most surprising and decisive thing for the markets and where the market had to catch up. Because before that, I think the market was really taking the polls to heart that it was a very, very close election. The Senate was probably going to shift to Republican hands. The House was not very clear. And so this Republican sweep, and particularly the quick conclusion of the presidential election, was surprising the market. And I think that's where we got swept up in the week. As we started to get the news about potential policies and the potential cabinet picks, I think the market wasn't quite sure how far would policies go. I think there was some hope maybe that they wouldn't be particularly as aggressive, particularly on the tariff side. And that's what we saw walked back this week. And I think we have a lot of questions that have yet to be answered. And, right, one, we still haven't seated a new Congress. Two, the president-elect is not yet the president. That's still a couple months away. And three, we still need to fund the government. That's coming up first of the year. And so we need to get a new budget resolution through to just extend into at least the new Congress. So I think there's a lot of uncertainty for the market as we push ahead, and we may have gotten a little ahead of ourselves in terms of pricing in what a Republican sweep may mean and exactly how quickly will policies come through.
There may have been a bit of optimism, maybe excessive optimism, on the degree to which the Fed would be easing before the end of the year and into next year. I think that's the other wild card, right? I mean, if you listen to what the Fed chairman said after the November policy meeting, maybe the market is a little disinclined to make big bets on aggressive rate cuts going forward. Is that a safe bet? And maybe the rethinking on the path of the Fed has contributed to the kind of the pullback in the equity market to some extent.
I think that's absolutely right. And we heard that in speeches last week as well, with Chair Powell kind of walking back expectations that he had to cut at the December meeting. I think the most important thing, though, we heard after the November meeting was that they were very data dependent and they were watching the data rather than trying to anticipate where the data was headed. And I think that's what we'd point to as to for the markets is that the Fed's not really on a fully predetermined path. They're in an easing mode. They want to normalize policy, but the pace of that is really going to depend upon the economic data, which we know in the U.S. has been quite resilient. Retail sales last week were quite good. The consumer sentiment numbers look to be improving. Inflation is slowing, but slowing very slowly, right? We're still kind of elevated in terms of prices. So I think that gives the Fed room to pick their way through this normalization process.
The other important data point this week will be the earnings from NVIDIA. The stock was down a little more than 1% today. It was a report in the publication, The Information, that indicated that NVIDIA had asked some of its suppliers to change the design of server racks for those new Blackwell GPUs because of an apparent problem with overheating. Now, when it comes to earnings from NVIDIA this week, what are you going to be looking for?
Really, we're looking for what is their revenue growth expectation? Artificial intelligence spending has been entirely focused on that acceleration in revenue growth. It's concerning to see how the market treated Microsoft Azure after the cut in their expectations for their revenue growth by a point or two for coming quarters. And I think that's what we're going to focus on in NVIDIA is the growth rate still the same? Is that finally coming off the bloom? And so is the market maybe pricing a little too aggressively for growth coming out of that sector? Before
we get to NVIDIA, tomorrow, I think, before the opening bell, we'll hear from Walmart. This is going to give us a little bit of a sense on the health of the American consumer. Do you have a read on the consumer at this point?
Well, the consumer is, on average, really solid. But I think what we're watching from both Walmart and Target is how is the lower income consumer doing? Is that starting to fall off? Is that a sign that things are getting a little tough for the consumer, or are they doing okay? Because when we look at the headline numbers, the average consumer seems to be doing okay, but what's really happening with the lower income segment? And that's where we could start to become concerned that maybe the labor market is tightening quicker than we think. So that's really what we'll look for coming out of there. I think the second thing for both Walmart and Target is, are we seeing a shift where middle to higher income consumers are becoming concerned about their budgets as well? Or are they confident enough to buy the name brand products? We'll have to watch that from both those companies. I
want to talk, before I let you go, on whether or not you're seeing opportunities offshore. I mean, we know that Europe is very weak right now. Pockets of Asia are struggling, principally China. Are you seeing anything worthwhile outside of the U.S. these days?
We do think there's some improving growth coming out of the rest of the world, and I think it's tough to say that it's accelerating, but I think it's less worse, and valuations are particularly cheap. Additionally, we have both the European Central Bank and the Bank of England on a more aggressive cutting cycle, which should ultimately support the European economy, support the economy of the United Kingdom. We saw decent GDP numbers out of Japan, not great, not accelerating, but at least decent. So we think there's some opportunity that it's worth looking at those cheap valuations, not aggressively, but it might be time to start picking and choosing some allocations outside the U.S.
Rob, we'll leave it there. Thanks so much for making time for us. Rob Haworth is Senior Investment Strategist at U.S. Bank Asset Management Group, joining from Seattle here on the Daybreak Asia podcast. Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Joining us now is Zachary Hill. He is head of portfolio management at Horizon Investments, joining us from Charlotte, North Carolina. Zach, thanks for making time to chat with us. I want to know how you're viewing the change in administration and the impact that it's going to have on the outlook for corporate earnings next year, if we can only go that far out. Do you have a sense?
Sure, Doug. Great to be with you today. I think we're trying to assess right now sort of the balance and priorities of this incoming administration between one set of policies that's pro markets and good for corporate earnings and the economy more broadly, and that would be deregulation, lowering taxes, and then just unleashing animal spirits amongst the business community. That's the positive side of things, versus stirring the pot in terms of global trade, potentially imposing really punitive tariffs across the board on our trading partners, which would obviously be negative. And so, as we're thinking about it broadly speaking, we see the economy doing pretty well into this change in administration. And so, continue to see that. It's just we're trying to assess the balance between those two priorities, and certainly, I think watching appointees and the like in terms of which comes first and what's going to be emphasized in this new administration.
Many of the political analysts that have looked closely at the election results have pointed to the fact that there has been or was a little bit of anxiety about the economy expressed in voting. And I'm wondering how you're viewing the overall health of the American consumer right now vis-a-vis these election results. That seems to be the case that a lot of people are struggling and they're worried about persistently high inflation.
Yeah, I think inflation was a huge issue in this election. There's nothing more topical than gas prices, and so that's obviously going to be a priority for the new administration to try to get gas prices lower. That has a lot of psychological effect on consumers. But broadly speaking, over these last few years, if you ask people how they feel about the economy, they've been very, very negative. Some of the readings on consumer confidence were as bad as they were in 2008, 2009, for example. But if you look at the objective measures across the broad swath of the economy, consumers are employed. They have plenty of runway in terms of the ability to take on debt if they need it, and they have very strong balance sheets. And so we put all those things together and think there's more underlying strength in the economy than a lot of people have given them credit for. And certainly if you're listening to what consumers say on surveys, you would be very much surprised by the economic strength that we've seen over the last few years.
Maybe that's one of the reasons that the Fed is taking a kind of a slower approach to rate cuts. Not only the fact that the economy seems to be very healthy, the job market seems to be strong, but there is, with a new administration, maybe a little concern that some of the policies that could be unleashed would contribute to maybe a pickup in inflation. Where does this leave the Fed right now? Trying to understand where the economy is and what the path forward may be, given this new administration that's going to unleash very, very different economic plans.
Yeah, I mean, that's certainly something the Fed is grappling with and the market. And I think we're all in the same boat on this. We're just watching the incoming data. And, that's been tricky over the last month or so because of the distortions from the hurricanes and the strikes that we've had across this country that will likely to continue to be tricky, as we get a new administration and a new set of policies and priorities coming out of D.C. But, broadly speaking, we think the Fed is in a position where they know rates are too high. They just don't know how high, how high they are. And so, that likely sets them up for, another 25 basis point cut in December, and then a bit of a wait and see. And certainly we had Powell suggesting that last week, and then kind of just see how the economy evolves. And if we have stronger growth, that means we'll have higher rates. And if we have weaker growth, that means we'll have lower rates. And by and large, we think equity markets, other than a little bit of indigestion over the near term, can handle either of those scenarios.
Where does that leave the fixed income markets? Would you be inclined to put money to work in certain bond markets right now or not?
That's a challenging backdrop for fixed income markets, and I'm not even mentioning any concerns about fiscal and term premium and long-term rates and that type of thing. And so we've been dipping our toes certainly into parts of the fixed income market that we might have shunned when the curve was inverted. But broadly speaking, you're still not getting paid very much for terming out your exposure there. And so we've tended to like credit. It fits with our overall economic view, and the coupons on offer in the short and intermediate part of the curve are quite attractive on a total return basis. And so that's been our focus in fixed income, and it's been a relatively consistent one for us.
Where are you when it comes to the equity market? Are there themes there that you believe will return decent returns going forward?
Absolutely. I mean, broadly, we're positive on equities, and especially U.S. equities, and certainly that is not just because of what's happened over the last 2 weeks, but just because of the broad earnings power of corporate America and the resilience of the economy, especially vis-a-vis the rest of the globe. But I think two themes are really interesting right now. I mean, one is the AI theme, and we have NVIDIA coming up this week, and they're the most important stock in the world. That's important for the overall sentiment towards that part of the market. But broadly speaking, semiconductors have not really been leading global equities, since about June or July of this year. And so that is a pretty noticeable change. And so it's, for our perspective, helpful to see, some of that AI trade broaden out into some software and service providers that are adjacent to the theme. And the other part of the market that we do like are some select cyclical parts of the market, that have some tailwinds from a stronger economy, from interest rates, and from the potential for deregulation. And so two there that stand out are financials and small caps more broadly. That doesn't extend to the entire universe, and we do think you want to be selective in that area, because we still have that overhang of potential for higher rates weighing on sentiment of parts of the market. But those are the two areas that we like. And then, defensive sectors, which did really well in the third quarter when interest rates were falling. We don't really favor those at all. We don't see how they translate into our view from a portfolio construction perspective at this point.
One of the tenets of the Trump economic plan is to drill for a lot more crude oil in the U.S. Are you playing energy at all right now?
Yeah, I mean, you would think, kind of based on that overall view, that cyclicality would be in favor, and energy certainly is one of the more cyclical sectors out there. I do think it's a little bit of an open question. We've had just a lot of global supply. The OPEC compliance has not nearly been as strong as it has in years past. And then B, the potential for more supply in the U.S., and going back to that idea of trying to get inflation down, and the salience of gas prices into consumer psyche around inflationary dynamics, that is potentially good for the overall economy, but not necessarily good for equity holders in energy companies. And so that's a part of the market that we don't favor at this point. Remains to be seen on policies, and certainly we're watching that space very closely. But that's why I think you need to be a little nuanced when you're thinking about more cyclical exposures at this point.
How are you viewing markets offshore right now, especially in Asia? Is there anything in that region that you like right now?
The international markets have just really struggled for catalysts over the last few years. And, the market had a very large rally in China, and we've given quite a bit of that back, as it's been clear that, stimulus, even though it is forthcoming, is not going to, meet the standards of offshore investors. And so, emerging markets is a part of the global market that we like more than we have in the past, but, still is really difficult to get behind, meaningful overweights to that sector. But if I had to pick kind of one place internationally that I do think has some nice tailwinds, it would be Japan. Very cheap currency, normalization of policy, and just the structural reforms that corporate Japan is undertaking. All of those things, even though that trade has been more volatile over the last few months, all of those things are more positive than anything we see coming out of Europe or broad emerging markets at this point. So that's the one kind of highlight we look overseas.
A big question is whether or not we're going to get a rate hike from the BOJ as soon as December. A lot of folks are saying maybe it doesn't come until January. Zach, thank you so much for taking time to chat with us. Zachary Hill there, the head of portfolio management at Horizon Investments, joining from North Carolina here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.